everybody in Turdville. It's Thursday, June the 5th, and it's time for another A2A. This week's guest is someone we first had here for an A2A back in October. I can't believe, where has the time gone? Because now it's June. We have here in our presence once again the one and only David Morgan. David, who many of you know, is a silver expert of great renown. How's that sound, David? Pretty good?
Sounds overdone, but that's okay. I'll take it.
He's the creator of the website silver-investor.com. He is the publisher of the Morgan Report and an expert in all things silver. So, David, with that as an introduction, thank you for joining us. How are you this fine morning?
Well, I'm doing quite well, thank you. Other than the price of silver, things are doing well.
Well, perhaps we'll start there. It's been interesting to watch these last couple of months. You know, they drove price down almost exactly a year ago, down to whatever it was, 18.20 on the last day of June last year. Then they drove it back down and tried to bottom it out again at the last day of December last year. Now here we are in June again, butting up, under 19, back above 19. How do you feel about price at this point as we head into the second half of the year?
Well, to remain consistent. I mean, I've been on several interviews, and I have stated, right or wrong, that I think the bottom is in. And it was, as you said, that 1817 print that took place on the 28th of June, 2013. And as we speak, in early June, a year later, that is the low print. So far, that is the low, meaning the low for this intermediate term from the high of the end of April 2011. So will it hold or not, I think, is the big question. We're very close to it, and I have told my paid members, so I don't mind doing it to your group, and I've done it in the public now, my thoughts on it. Just, protect my people. I want them to get the best information, our best thinking, and get it the earliest. But I've warned them that if we get three closes under 19, that the 1817 level has about an 80% probability of being tested.
Yeah.
So we've been under the 19 level. We're over today because I guess the ECB, the European Central Bank, has said they're going to start charging other banks for excess reserves, which forces them to get the money out of their banks. And the only way to do that if you're a bank is to loan it. So this is probably, if you're very, astute, a very strong indicator that the Europeans may be the first to force feed inflation. And what I mean by that is that they're going to make it attractive for businesses or individuals or both to come borrow money, because if they don't get it out of the system, they're going to be charged. Now, all this, I think, is still in the talking phase, so I may be getting ahead of myself, and I don't have all the details at all, but the facts are correct. The stimulus, the way to get the economy moving or to inflate it, is to force the banks to loan money. People have asked tons of questions about why all this printing has not caused any real inflation. And there is real inflation, but, in the manner that we expect. In other words, funny money going into the hands of the people. And it's been very stagnant because all that money's been sitting in the banks. It hasn't been pushed out into the economy. It's gone into the stock market. The banks have used it to force feed the stock market higher, but that's really about the only place it's gone. It hasn't gone into businesses. It hasn't gone into the public. And now if Europe starts that, it won't be instantaneous, but it'll start a trend. Once that starts in motion and it gains momentum, it gets that criticality, and especially if the U.S. joins in and does something similar, look out. So that's something to watch for. So I probably got off track. Back on price, I think the worst that could happen is another spike low somewhere below that 1817. And all my work and experience still to belief. It's not a fact. We don't know. But I've watched this market for so long. I think that if it were to make a new low, it'd be a spike low.
Yeah.
So it could go to, say it spikes down to 16. I don't know. Silver could surprise even me. But I think it bounced right back up. It'd be very similar to what happened on that 1817 print. That was a key reversal. Key reversal is when you hit a brand new low during that day, and during the same day you hit a high that's higher than the high of the day before. It closed that day at like 2006. I don't know.
Yeah.
I know the 1817's exact. I forget the exact close, but it was $20 and change. So that was about a $2 move in one trading session. Key reversal. They're called that because they happen very rarely. And what that means is that when it hit that 1817 print, there might have been one contract traded. There might have been two. There might have been 10, but I'll bet there were less than 5. Because all the professionals, all those shorts, all those naked shorts out there that everybody knows about said enough is enough, I am covering. And once they start covering, all these boys pretty much know each other. A lot of it's off-board trading electronically. They see it. They know. They know the game. They know the game better than a lot of people. So they see that it's being covered. They will cover too. They're not going to get the last penny. That's it. So there's massive buying, and really what it wasn't buying, it was buying from the aspect of a short covering, which is a buy, moved the price massively up from 1817 to over 20, and that's where it closed that day. Does that prove that it's the bottom? No, it doesn't. But I think that proves what the thinking was at the time. Well, since then till now, about a year later, what's going on in the silver market? It's been in the doldrums, but there hasn't been, huge influx of new mining capacity. Yes, it was up over the year. I mean, basically, it's been pretty static, which is what the chart shows. I mean, we moved up and down a few times, got into the 20s, and I think we got up to 25. I thought we could get to 26 by the end of the year. And I said that in the public, and I told my private members, look, because someone wrote me, or I would have done it anyway, but, a lot of them at the basic plus level, they're allowed to write me directly, hey, David. And, they're very good. They don't really pester me. They usually have great questions. And, David, are we really going to see 26 by the end of the year? I said, absolutely not. And I went into my charts, and I showed them why, and on it goes. So probably just beat that one to death, Turd, but if you want to follow up or I didn't answer something. So is a new low possible? Yes. Probability of it, not very good. If it were to happen, and I think the probability of it happening is pretty low, making a new low. Doesn't mean we couldn't, I don't want to sound like I'm inconsistent here. The probability of testing the 1817 low is probably around 80%. But that's testing that low, which means it could sell, and it gets to 1837, okay? And that's when all the naked shorts that are left, which aren't that many, come in and say, good enough, I'm out. I'm buying back my short. I'm buying back my short. So that would be a test. In other words, it's like they're forcing it as low as they can, and it doesn't work. I'd have to see trading after that, because I'm pretty good about letting the market tell me what's going on rather than me tell what the market should do. But that would be an example of testing the low and it holding. And then if we got luck over 19 and closed over 19 on good volume for like a week, that'd be pretty good confirmation. Again, probably like in the 70% probability that it's over.